This podcast is looking at how to answer an explanation question involving interpreting a provision for doubtful debts ledger account. A comprehension question is 50 to 100 words in length, and what I've provided here to you is a breakdown on how to answer such a question. Now, what we've got here is basically a ledger account which looks at how much bad debts have written off for the year, how much is the estimated for the following year, and how much opening balance we had for doubtful debts. Now, provision for doubtful debts is a contra asset account, which basically means it is treated like a liability, but it is seen in the current asset account and thus reduces accounts receivable. So the opening balance here is $200. This amount here, bad debts expense written off, basically means the business has written off during the year $500 worth of bad debts. And then at the end of the financial period, the business has deemed that future bad debts may include or add up to $800. So this is the balance of the provision account for the next financial period. This amount here of $1,100 basically means we are providing in this financial year also $1,100 to be written off as bad and doubtful debts. So in essence, we are seeing here that the business is actually deeming about $1,600 worth of bad debts expense for the year. So that's the addition of what was written off and what is deemed to be written off for a future financial period. So in order to answer this question, the first thing that you need to do in any comprehending question is to discuss and interpret and define key accounting terminology. And this question is what is a doubtful debts account definition, and a definition and an aim for a doubtful debts account. Now, doubtful debts can also be deemed to be a bad debt or a bad and doubtful debt, so they're the same thing. So in essence, your answer, if you get one of these in the IA2, will be looking at defining what is a provision for doubtful debt. And the key things that you need to include in your definition is firstly, the definition, what a doubtful debts account actually is. So I'm going to put that in red. So it is basically the amount of doubtful debts that must be written off during a given period and how this account is actually accounted for in the statement of financial position. And so we can see here that a doubtful provision for doubtful debts is in essence a contra asset account, and it can be seen under the accounts receivable, so therefore it is a current asset. The next key definition that you must include and define within your answer is what is a doubtful debts expense account. So a doubtful debt is an uncollectible in the next accounting period. Doubtful debts are treated as an expense, and in particular, it is a finance expense, and the account ensures expenditures are matched against the sale in the same accounting period. So therefore, you're applying a key accounting assumption called the matching principle. Now, in analyzing and looking at this account for a business, you can see here that they'll have liquidity problems. Now, liquidity is basically the amount of cash that may be received or not received during a financial period. So you want a business to be highly liquid. In other words, they'll have a lot of cash as opposed to be an increase in doubtful debts being written off for the period. So you can see here the bad and doubtful debts has increased by $1,100, almost twice the write-off from the current financial period. So that is not a good position to be in. The increase in the balance from 200 to 800, so the opening balance was 200. Now the closing balance of 800 also represents that the business is likely to incur more cash flow issues due to more accounts receivable deemed to be written off during future accounting periods. So the bad and doubtful debts has increased by 1,100, almost twice the mid-month journal. So that's the mid-month journal there. that is what is getting further written off for the year. And because it is deemed a finance expense, the bad and doubtful debts and bad debts expense will reduce the net profit and the cash flow of the business. Furthermore, the increase in the closing balance from 200 to 800 further demonstrates an increase in future write-offs. Because the balance has gone up by $600, the firm is saying our accounts receivable policy needs work, and therefore we are likely to incur future bad debts. And then because the provision is a contra account or contra asset, the provision for doubtful debts, so I would, to minimize words, put this as provision for doubtful debt as PDD, impacts the current asset. So we're looking at liquidity here. So you need to mention what ones are impacted here, and also the quick asset ratio, as the accounts receivable will be reduced by this $800. Okay, so you must answer the question on how it actually reduces liquidity. And liquidity is summarized by calculating the current asset ratio and also the quick asset ratio. Okay, thank you.